Kia ora. Welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name is Helen Mattison. Today on the program, we'll be taking a pulse check of the economy with our regular commentator, Infometrics principal economist, Brad Olsen. We'll look at some of the key metrics, upcoming trends, and there'll be something for everyone, whether you're a mortgage holder, investor, or a consumer. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Brad. It's a while since we've had you on the program. What's been happening?
I know. Well, it's been a busy year. I've been travelling a fair bit, both overseas and across the country. Great way to see the world and see what's happening in the economy. Get a bit of a different feel for, how other economies are going. Is New Zealand in the same path? Are we tracking slightly differently? And I think what's interesting is that, there is a mixed bag. On some things, we're very, very similar to the rest of the world. On others, we seem to be charting a slightly different course. But really, everyone's still interested in interest rates, and it seems like us and the rest of the world are going to take a little bit longer to get to that point where we can actually start cutting, providing a little bit more relief back into the system. So we'll get there. It's just the light at the end of the tunnel is getting is a little bit further away.
Yeah, that light at the end of the tunnel is quite nice to focus on because you have to admit the last year has been pretty bleak when it comes to the economy. I've avoided doing an economic update for listeners partly because of that, because it is pretty damn depressing. However, it does seem the global economy is turning. Back here at home, as you say, there are differences. We've got unemployment edging up. We're technically in a recession. Wage growth is coming off. However, I did see this week the Reserve Bank did put out its quarterly expectation survey, and that actually shows near-term inflation is declining. It gave a few figures for 1, 2, 5 and 10 years. The 1 and the 2 look like about 2.73 for the first year, 2.33 for the second year. That's near term, but would you say that is boding well, given that that's under 3%?
Oh, it's certainly getting there. I mean, the 2 years probably the one we'd focus on the most at the moment. It was at 2.5% if you went back 3 months. Now, like you say, 2.33. So it's coming down. It's coming down sort of solidly. It's not there yet, and we sort of wouldn't expect it to be. But it's another part of the puzzle for the Reserve Bank. They're looking at all of that data, both real data they have to then extrapolate forward, those expectation surveys where they're trying to figure out what are businesses, what are forecasters themselves thinking. And I think, again, doesn't, in my mind, sort of immediately go, yep, we're done, it's all over, everything's fine. But it's another part of that puzzle saying we are getting in that better direction. What's probably more interesting, I think, is that, you look at those 5 and those 10-year figures, they should really be anchored around 2%, and they're actually still a little bit above it. But a little bit above it in 10 years' time still suggests that professional forecasters are thinking that sort of basically trend inflation is going to be higher over the next decade. So that's not necessarily, I think, a question for now because we're trying to get through the current bout of high inflation, but it does sort of question, will we be having to think about that higher inflation in years to come? Quite possibly. But it also gels with some of the other surveys you've seen coming out, business confidence surveys, for example, which sort of paradoxically say that actually businesses are expecting that next year there are better things to come, even though right here and now still feels pretty challenging. A lot of the reports coming out from businesses saying, look, no one's making a lot of money, or it's a lot more challenging, costs are still high. So everything we're talking about is sort of doom and gloom right here and now. But business confidence is in positive territory, and it does sort of say, look, we're in for the challenging piece right here, right now, but next year those green shoots are a little bit more active.
And it's always good to look ahead. While you're in it, it's not a lot of fun, but that light at the end of the tunnel probably keeps everybody on the level, if you like.
Oh, absolutely. And I think for a lot of businesses at the moment, the question for them is not necessarily, is it good or bad? It's fairly clear that it's not that great at the moment. The question is, when does it turn around? And I think, a lot of people had been expecting, both here and in the US, for example, just give it a few months at the start of 2023, then interest rates will come down, then everything will roar away again. And every single month, just about every single day, we seem to push those expectations out and out and flatten out. I mean, you look here in New Zealand, those expectations for interest rate cuts now more sort of November this year, if not early next year. You look at the US economy, still pretty firm in terms of numbers around jobs and slightly still too high inflation. But again, the Fed's been saying, look, we were thinking of doing this many this year and now we're doing quite a few less. So again, just pushing out the boundaries a bit on how quickly that interest rate relief comes through. And without that, the economy more generally will remain subdued. Households aren't going to be spending as much. Businesses won't be investing as much. Sort of everyone holding their powder dry for that better time next year.
So I'll get you to call the interest rate changes, if in fact we do have any. Next week is when the official cash rate does get reviewed once again by the Reserve Bank, currently at 5.5%. What do you think is going to happen?
No hope of anything but a change. I'm sorry for the moment. Expectations pretty firm that the Reserve Bank's getting better information, but not enough to sort of, make a change call yet. We were originally thinking maybe August would be the sort of time frame. So far, it's just enough of that persistence and stickiness around inflationary pressures, particularly the non-tradable stuff. The fact that, headline inflation has declined is good news. All the other indicators sort of showing the same. But the fact that non-tradable, so domestically based inflation, barely budged, that sort of says to us, look, still, if I'm the Reserve Bank, I'm cautious about going too early. So our current pick is November. I think what will be interesting in the Reserve Bank's May announcement is that they'll probably have some inside word on what the government will be doing with the budget. They can't talk about it, they can't forecast it, they've sort of got it in the back of their mind, but of course the budget comes out then a week after the Reserve Bank statement. So a little bit of sort of what do we know and what do we share and what do we actually talk about, I think. So maybe some smoke and mirrors next week.
So with the budget, normally it doesn't make a lot of odds for investors. They kind of keep going along the merry way. However, this is a first-time coalition government budget, and we have had lots and lots of cuts and various other changes. Are you thinking of any surprises? Is there anything that maybe investors this time should be taking note of?
I think there's probably three key things that people will be looking for in terms of both investors and others that just work in the business community. One is there any further cut coming for the public sector? We've known and seen that quite a number of private businesses have been influenced by that, having to cut back their own teams or sort of thinking, where is that co-investment opportunity? Maybe it doesn't exist anymore. So a bit of an idea around that. The likes of tax cuts themselves, there's big talk on that. What does that look like? And probably importantly, what does the Treasury think that means for actual spending? If I'm anyone in that sort of retailer position or similar, I'm going, well, households with more money in their back pocket normally means more spending for me, but does it come through fully this time? Or again, are mortgage rates and similar going to eat that up? But the last one is probably around infrastructure investment, because I think, we've got a number of those sort of more defensive assets in New Zealand, particularly around energy, but also more generally around infrastructure. That question of what's government doing? Are they sort of pushing ahead? Have they had to pull back? Is everything becoming a whole lot more expensive? There was some talk a few weeks back about getting rid of one of the resilience plans for infrastructure that was introduced last year. That was an accidental leak from the Treasury, but there is sort of, I think, this underlying question of where are we going next with infrastructure, because it's costing a huge amount of money. We're not necessarily getting great gain from it at the moment. We know we have to get more bang for buck, but sort of what's the government's intention there? That's something I think some investors will be looking out for.
Brad, just thinking about house prices, it would appear in some parts of the country, Auckland would be one, where they are edging up. What's your take on where the prices are?
They're edging up, but quite slowly, and I think in our minds there's still a lot of competition that'll keep that sort of house price growth more subdued. It might well be positive for the year, but it's still going to be pretty limited. And I think the big thing at the moment is you've got just such a huge bow wave of listings coming through. Households who are trying their luck, thinking about downsizing or similar, but at the same time, buyer numbers, there's still not a lot of them. Even though you've had high levels of migration, that's putting more pressure on the rental market than the housing market, because not that many people can walk into the bank and get a loan all that easily. And so I think what you're seeing or going to see happen still for the next couple of months is there's a lot of options out there. There might be one buyer on one street and there's 5 options for them to choose from. That means that either if you want your house sold, you've got to come in with a lower price to beat the other 4 on your street, or you're going to miss out. And so I think those competitive pressures will keep a fair cap on house prices. Most of the figures so far are suggesting the same. The likes of asking prices aren't moving hugely upwards. So I think that sentiment is still a little bit subdued, I think, as well, until interest rates shift around. Those expectations of house prices are just going to have to remain pretty low. What's interesting is that this would be the first time in a while that high population growth hasn't stimulated high house price growth, right? But it has very much been coming through on that rental figure. You're seeing those rental growth numbers at quite a steep rate. I think on the Stats NZ figures, fastest rental growth since at least 1997, back at the first quarter of this year. So a lot of rental growth, a lot more people wanting to live somewhere. We haven't necessarily produced a lot more houses. On the housing front, because a lot of those people can't go and get a loan and similar, they're just not really actual potential buyers. So it's still a buyer's market out there in my mind in the housing market. It's just that the limitations mean that sales numbers are not going to be cranking up all that strongly this year.
And lastly, for investors, it would appear that the still costs are fairly high and they don't seem to be coming back into the market as yet.
That's correct. And I think, again, what's probably interesting is that you look at some of the rental yields you can get, 3.5%, say, when you're paying a mortgage rate in the high sixes. It just doesn't make a lot of sense. You'd be better to put the money in a term deposit and not have to worry about all the rental sort of stuff, unless you think there are those stronger capital gains coming through. And at the moment, that's harder for them to look at and go, that's definitely going to happen. So I think that sort of cash flow element of investors having to put a lot of money into a property if they bought it, they're probably waiting a little bit until those sort of things normalise. Those higher rents will be helping to try and bring back the gap, but it's still probably too large at the moment. They'll also, I think, be wanting to wait and see themselves on those interest rate cutbacks. Everyone got super keen at the start of this year, far too overzealous really. The question now is sort of what is an actual reasonable position, because you've still got a pretty big gap between market pricing and the Reserve Bank. The truth is probably a little bit more in the middle, but until that becomes clear enough for investors to sort of actually make investment decisions on, I think you'll see them hold their powder dry until that opportunity starts to create itself again.
Just also, when you look at the different markets, they are quite different what happens with housing in New Zealand. Are you seeing any changes, for example, in the bigger cities or some of the more rural areas? Or
you're still seeing that some of the sort of areas that normally have had some pretty strong demand around the likes of Central Otago, Queenstown, those prices are jumping back up. Not necessarily in leaps and bounds, but way more than the rest of the country. And I think that speaks to, again, that sort of level of demand in those areas for some of that higher end property. The likes of Wellington's probably seeing some better growth numbers than we might have first expected, but they're also coming off pretty deep lows, so it's a lot easier to achieve that. With the likes of some of the changes around government spending, the likes of public service cuts and similar, I think you'll see a bit more of suppressed demand, just because, again, a lot of people won't be able to pay mortgages, certainly won't be able to buy a new property, but the likes of Auckland and then probably some of those regional provincial areas, they'll follow in a bit. It'll take, I think, a little bit of time for the regional areas to really pop off again.
Just looking also back to the global economy, it has a huge effect on New Zealand whether we like it or not. You've been travelling, as you say, in recent times. Japan, I think, was one destination. That's a pretty interesting market. I know you've been to China last year as well. I'm kind of interested in the comparison there. China's been a massive trading partner, or it's our main trading partner, and things have come off there, so it's been a risk for investors. What about what's happening with Japan? How's that faring?
Japan's been a real fascinating one. As a traveller, I got quite a good deal there because I was there when the currency was plummeting. So all of a sudden, things were becoming relatively cheaper, which was great.
What did you buy, Brett?
Oh, what didn't I buy is probably more the question. It was just one of those things of travelling to another country. Normally, travel's quite expensive. And I'm not saying this was a cheap trip, but I sort of felt like I was paying the same, if not probably slightly less, for a dinner out in Japan than I would be in New Zealand, which is always nice as a traveller. But I think as well, I was going over just after you'd seen some of their stock market figures hit their highest since, the 90s, since the asset bubble burst, the likes of, changes in their monetary policy. They raised interest rates for the first time in 8 years or something incredible. They're actually seeing inflation coming through in their economy. So, things that you almost would have never expected. I know. It was what a time to be alive to see, Japanese Japanese interest rates come up. But it also highlighted that some of those pressures are still very much coming through for the Japanese economy more generally. They've got a big aging population. They've got, it's into the millions now, the number of sort of homes and apartments that are going spare because people aren't living in them. So still a question, I think, over where to next for the Japanese economy and how it plays into the rest of the global system. But, and this is the thing I probably didn't appreciate until I went there, it's a massive economy, and I don't think we sort of give it credit for that. It's the fourth largest in the world. It's New Zealand's fourth largest export destination. They take a lot of our stuff. And interestingly, talking to a number of business people, they said, look, one of the things to look out for in the sort of thinking about exports and what have you, some markets are big in terms of value and volume and similar. Some are big in terms of profitability, and Japan seems to be one of those markets that they might not be the biggest overall, but they might be quite a lucrative, quite a profitable market. But it also taught me, I went around, talked to some business people, a good holiday, as every New Zealander does, talking to some business people, but I was asking, what are some of those trends? Private consumption hasn't been fantastic at the moment. They're always trying to stimulate a bit more spending, but business investment had surprisingly been quite firm. And the question I had was that some of that sort of geopolitical posturing, everyone trying to nearshore or friendshore or whatever they talk about? What it actually seemed like is businesses were looking at those opportunities and going, actually, at the moment there's a premium from the quality of being a Japanese-made product in the region, and so they were trying to capitalise on that a bit more. So there seems to be some strategic sort of business positioning going on, a bit more business investment trying to get them ready for the future. So it was good fun. It was an exciting trip. It made for some interesting economic trends. I mean, just the way of operations that they have was stunning. In New Zealand, right, we're a 9-to-5 economy. Over there, you wouldn't find much open before sort of 10, 11, but it'd be open until 8, 9, 10 o'clock at night. Vending machines galore. You can get ice cream, hot coffee, soup, yogurt, whatever you want from a vending machine across the place. So great fun, very convenient, but just a very different lifestyle and a very different economic makeup.
Do you think there's potential for New Zealand as a partner? You talked about it being number 4 of our trading. Are you talking high end? It sounds like that's what that's coming across. Is there opportunities there for New Zealand to increase that relationship in terms of not just volume, but obviously value? And where do you see, what industries do you see that happening in?
Yeah, I definitely think there is. I mean, I think it's also probably quite a good opportunity to think of how we change the game a little bit on our food and fibre sector, because a lot of the time we talk about commodities and similar. In Japan, they've got quite a refined palette, if you will, in terms of like looking for those slightly different options. Instead of it being milk powder or sort of basic commodities, they're looking for some of those sort of more foodstuffs items. So, how can we think of introducing more dairy into, canned goods or similar, rather than it just being sort of a key export commodity? I think as well, I mean, we do quite well, it seems, in providing them with sort of an alternative supply or, sometimes a sort of counter-cyclical supply. I think New Zealand squash, for example, we provide in to the Japanese market for the months that the Japanese local market can't supply. So, an opportunity there to look at those sort of options to go in at the right time with the right sort of product. But they're quite keen on New Zealand, where it's sort of a good, respected, trusted provider into the country. And I think that's something that over time is making a much greater deal of importance in trade. Trade is not nearly as economic as it once was, which sounds a bit ridiculous to say, but it is now more geopolitical. Where those sort of interactions lie, where the sort of strengths and the safety and security come through are increasingly important. So I think we've got a good opportunity to leverage that there.
That's a nice segue to how you think our exporters are faring, whether it be Japan or China or any of their other key markets. What's your take on that?
So we've been pretty dark on that for a while. It had been looking sort of fairly grim. And you look at some areas at the moment and prices definitely aren't great. And that's a global demand and global supply issue. You look at the likes of forestry returns and some of the export prices just the last couple of months, down I think 12 to 20%. So, that's a pretty steep fall. Again, part of that is the Chinese economy. They're not doing as much construction, therefore not as much demand for wood. even here domestically, we're not building as much. So forestry still challenging. The likes of meats also seeing some pretty low prices coming through. I think lamb prices are at sort of a 7 or an 8 year low, lamb and mutton and similar. So all of that not great. Again, demand coming from overseas, not fantastic. A lot of supply coming through from the likes of Australia though. So high supply, low demand equals prices coming down. So those are sort of the challenges. Dairy though has definitely been improving. That's coming back up, and that's good for return to farmers, but also for New Zealand's general export picture. Horticulture's been quite strong in recent times as well, particularly, a year ago we were in the grips of Cyclone Gabrielle and the destruction that it wrought. Now we're into a better place. And looking at the trade figures, also looks like our fish exports were pretty good for the first couple months of 2024. So again, one of those things, I don't think anyone would go out there and say, just look, it's blindingly fantastic, cannot imagine it getting any better. But it is that thing where we've gone from not being quite so upbeat about it through to a slightly more robust picture, I think, on the export front at the moment. And part of that as well is, I think, you look at some of those areas of the world that are still performing well, the likes of North America, particularly the US. Consumption is high there. They're buying a fair bit of our meat, so that's helping. The likes of the Middle East as well, they've been buying a lot of dairy, some horticultural products and similar. So again, enough demand in different parts of the world, perhaps from our normal traditional places that we sort of generally think of as our trade key export markets.
Just looking back at the New Zealand economy, Brad, like at the start you mentioned that what's happening overseas, the US markets have been going gangbusters, particularly Sharesies investors know that. It hasn't been the same for our market. We've had many earnings warnings over the last few weeks, and it is quite depressing. And in the likes of retail, construction, even tourism, actually, tourism holdings, they had an earnings downgrade last week. What's happening there then? We aren't faring as well as they are. What's behind that?
Part of that is that we have seen a bit more of a plateauing or a continued plateauing in that sort of tourism recovery as interest rates have risen across the world, but also in the likes of New Zealand and Australia. As a household, I'm going, what's the first thing I cut? Probably the family holiday a bit more, or I'm doing it a lot cheaper, or whatever it might be. So that seems to be part of the shift. One thing that is coming through with a lot of businesses that I talk to is they say, look, things are challenging, but this sort of crisis, this lack of spending that's going on does sort of provide a bit more competitive energy in the market where businesses are going, look, I might be able to pick up some market share here if I can sort of work the right strategy. So there does seem to be a little bit of thinking of, gosh, it's tough, but also some opportunities amongst all of the challenges.
We've talked a lot about quite traditional sectors. Maybe if we look at tech and some of the sort of newer sectors, if you like, I mean, often they are, in these times, they do well. Are you seeing any industries, for example, that are maybe looking at this as an advantage, that the situation we've got, or aren't affected perhaps by the interest rates like others are?
I'd still love to be a chip producer, here across the world. I mean, I think part of that as well is where governments are starting to put their money, and so there's sort of not a lot of money going on out there, but there are some quite strategic plays. So the likes of the US is putting a lot more investment into that sort of chip area, and so that's generating a lot of returns. It's interesting as well, though, you look at the likes of, to give two examples, the likes of Apple, which has obviously got a much greater sort of consumer focus at the moment, hasn't been going as well. Those sales figures for iPhones and what have you just have been a bit lackluster. Part of that is where they're trying to sell in competition in China. Part of it is, again, households haven't got a lot of money, so putting it, trying to extract more dollars from households is difficult. But then you look at the likes of, say, Microsoft, or you look at some of the others that are working in the AI space, that's still got a real big sort of potential and premium that's starting to show through. And it does seem to be that area that's a bit more geared to almost business investment and business innovation rather than sort of pure consumer sales seems to have a little bit more oomph behind it at the moment. And I think that's still an opportunity for the rest of the year.
Coming back to the consumer, I mean, it has been tough times with interest rates, inflation. I mean, you just go to the supermarket and you see what happens, or like me this week, getting my insurance bill for the house, and the increase would have been at least 40%, and that's sobering. I mean, you feel like you've got to take out a loan to pay for your insurance. In terms of some of the income hacks, the ways of making ends meet, of being smart with your money. What are you seeing? Are you seeing any innovation in that space because of the situation we're in?
It's interesting as well, though, because if you look overseas, some of those insurance stocks have actually been doing quite well, which sort of seems surprising given how exposed that market is to climate change and everything else.
But on that note, though, so Warren Buffett had his Berkshire Hathaway, annual meeting a week or so ago, and insurance kind of was one of the standouts. I mean, I know they're heavily invested in Apple, but actually he talked about it being cyclical, that yes, we've had a really good run this time, but you're right, maybe next time it's not going to be so good. But in New Zealand, does that ring true for the insurance market?
I think part of it, and a big part of it, is that you've seen now a lot of households who are very unhappy with how large those increases are. I mean, my contents was up 32% or something, but we all pay it, because it's pretty important. You do see a few more people who aren't paying it as much, or some of the surveys out there suggest that people are moving their coverage, say, from comprehensive to third party to try and shift that cost burden. But from a business point of view, if I'm an insurer, I'm still making a fair amount of money because people sort of can't go without it. We saw that spending trends between 2019 and 2023 suggested that insurance was one of the sort of top 5 groups that people were putting more money into on a relative basis because of how important it is. So I think when households are now coming up with their, what are the essentials and what aren't, insurance is still in the essentials group, so it's still providing that sort of potential.
The financial services sector is always interesting too. Obviously, we've had a lot of bank earnings results out, and the profits are, up as usual. But there's a lot of commentators saying they won't be that high. They won't stay there. What's your view on that?
Yeah, I think that's true. I mean, I think there's a lot of teeth gnashing around the likes of bank profits, and probably fairly. I mean, I think one challenge looking at some of the figures was that, everyone focuses on the net interest margin, how much the banks make versus how much they have to pay out in interest. And it still suggests that there's a number of Kiwis that have their money locked away in something that doesn't generate them a lot of money. I
wondered that. Yes, I wanted to ask you, because people are probably thinking, where should I be parking my cash at the moment?
Somewhere that's making more than nothing. Everyone's paying a higher interest rate. You just have to. You don't get any choice. But on the savings front, there's sort of 2 pots of money. There's that savings pot where it does command a reasonable sort of return, and that on-demand pot where a lot of people do park their cash, forget about it, don't really make any money. So that's sort of, I think, dragging back savers a little bit at the moment. What's interesting on the interest rate front, though, because that is going to define, the rest of the economic year really, is that households are starting to move into a slightly more nuanced position. For the last couple of months and first couple of months of 2024, households, I think in the latest month, March, about 20% of new mortgages were for 6 months period. So quite a short period of time, which is quite surprising. Now, to be fair, lending is not booming, so it's not a huge dollar value, but it does sort of suggest that sort of calculus going on in households' minds where they're going, look, there's not really any chance of it going up now, so if I fix for 6 months, then it's not likely to be higher when I next come to fix. Either it's the exact same as what I currently have, which is just even Stevens, or it might have come down a bit since then. And you're starting to see a few of the banks which are they're not dragging it down hugely, but there's a bit of competitive pressure there where some of those interest rates are edging down just slowly at the moment. I mean, I feel like most of the interest rates people are looking at so far sort of are in the high 6s rather than the low 7s now. It's not huge, but it's a little bit of a trend shift.
I wonder if we will see a change, a bit like they have in Australia, where a lot more people have a mix of mortgage, fixed, floating, etc. New Zealanders tend to fix for usually 2 years, say. That's pretty much the most common thing. I wonder, with this change in environment, we're not going to go back to really, really low rates, as you said at the very beginning of this conversation. I wonder whether there's a change in thinking, okay, I need to have a little bit that I can not gamble with, but I can shove around as the economy changes, and I can take advantage of those points.
Yeah, well, and I think also, though, that the way that New Zealanders fix their mortgage rates and the fact that we have such a fascination and focus on housing does sort of mean that the interest rate flow through is slightly different. I mean, over here, right, most households, I think the Reserve Bank in their financial stability report said that 85% of households have sort of refixed onto those higher interest rates at the moment. The likes of the UK, for example, normally they're fixing for sort of more that 2 to 3 year rate rather than us at 1 to 2. So takes a little bit longer for them to come through. The US, they've got a 30-year adjustable rate. So what they do is that they keep going down and down and down till they get the lowest point, but they won't go up. Because instead of sort of refixing and going up, they'll just won't move a house. They'll just stick where they currently are. So I think, again, that transmission and what it does to consumers and how much they spend, quite different here versus, say, the US. And so I think that's one of the reasons you're seeing that US spending profile so much more upbeat than ours. You know, we're not spending a lot. They're still going on a tear.
Brad, we've talked about a lot today. I'm just thinking in the next 6 months, what would your takeaway be for investors to think about? What to look out for?
I think probably anyone who's thinking about particularly sort of retail and consumer activities, that's still going to be pretty subdued. I think households are going to be, you know, hunkering down still with those high mortgage rates for longer than first expected. But I think on that business investment front, there's probably a few more opportunities. It's not nearly necessarily across the board, but I think a few more businesses now that are going, look, there are some strategic plays I need to make now so that I'm ready when the economy starts to roar again. I want to get my ducks in a row. I want to sort of lock things up a little bit more. Certainly some of those sort of investment in the likes of technology and what have you do seem to have a bit more promise. To be fair, let's be clear, they've got a lot of risk as well, right? You know, how many times have you seen some sort of big bet on an IT thing fall over at some point a couple of years later? So they're not absolute certain, you know, going to the moon and nowhere else, but they do seem to have a little bit more upside. There's certainly more interest in how you use AI and some of the chip works and similar. I still think there's a question over particularly energy-based infrastructure investment, both here and around the world. Renewable energy is still an important focus for New Zealand and globally. We saw recently we had a cold snap and all of a sudden we're talking about generation and if we've got it across the country. So I still think there's a good potential to bring more of that forward, to see some better investment and hopefully better returns over time. But as you've seen with a number of the media companies and similar, the business landscape's pretty challenging at the moment for you know, some of that easier to cut stuff around advertising and services. So investments, I think, still strong, still subdued because of those interest rate figures, but once you start to get a bit of interest rate relief, a little bit more unlocking, the rest of the consumer market and some of those easier to cut bits of spending, making it a little bit more challenging for some businesses.
Thanks for joining us, Brad, and thanks everyone for tuning in. You can watch Shared Lunch on YouTube or follow the podcast on Apple, Spotify, or wherever you get your podcasts. Leave us a rating and comment as to what you'd like to hear next. But before we go, we have a special offer from BusinessDesk. If you use the promo code SharedLunch2024, you'll get $100 off an annual subscription to BusinessDesk. Terms and conditions apply. Find out more at businessdesk.co.nz. Enjoy the rest of your week.